AbbVie is the story of the most successful patent cliff navigation in pharmaceutical history. When Humira, the world's best-selling drug at $21 billion in peak revenue, lost U.S. exclusivity in 2023, Wall Street predicted a company-threatening revenue collapse. Instead, AbbVie's replacement drugs already generate more revenue than Humira ever did.
That's the key number to understand. Skyrizi and Rinvoq combined hit $18.3 billion in 2024, a 47% combined growth rate. And they're still in early penetration across their approved indications. AbbVie didn't just manage the Humira cliff, it executed a decade-long succession plan while growing the overall business.
AbbVie's corporate history starts with Abbott Laboratories, founded in 1888 by Dr. Wallace Calvin Abbott. AbbVie spun off from Abbott in 2013 as a pure-play pharmaceutical company, right at the moment Humira was reaching its peak. The spin-off gave investors a direct stake in what was then the world's most profitable drug franchise.
Humira's dominance was extraordinary. 7 different indications: rheumatoid arthritis, Crohn's disease, psoriasis, ankylosing spondylitis, each approved separately, each generating its own revenue stream, each protected by a separate patent. That stacked patent portfolio delayed biosimilar entry far longer than any single patent could have managed.
The $63 billion Allergan acquisition in 2020 was the diversification move that changed the thesis. Botox Cosmetic, Juvederm, and the medical aesthetics portfolio gave AbbVie a business with pricing power driven by brand equity rather than drug patents. Botox doesn't have a biosimilar problem. It has a brand that's become a verb.
Botox Cosmetic alone generates $4.5 billion annually, with essentially no generic competition. The brand is so dominant that patients ask for Botox by name even when the injector is using a competitor's product. That brand mode is qualitatively different from patent protection. It strengthens over time rather than expiring.
The business model today spans 5 franchises: immunology at 53% of revenue, hematologic oncology at 17%, aesthetics at 14%, neuroscience at 9%, and eye care at 7%. The diversification matters. No single product accounts for more than 20% of total revenue, which is a structural improvement over the Humira-dependent model of 2013.
The financial profile is exceptional for a large pharma. Adjusted operating margin is 47%. Free cash flow is $22.3 billion on $55.5 billion in revenue, a 40% FCF conversion rate that supports both a $11.7 billion annual dividend payout and ongoing pipeline investment at $6.3 billion in R&D annually.
The dividend track record is 12 consecutive years of increases, growing from $4.28 annually in 2019 to $6.56 in 2024. The payout ratio on free cash flow remains comfortably below 60%, leaving significant room for continued growth.
On the competitive radar, AbbVie scores 92 on succession execution, the highest in its peer group, reflecting the fact that replacing a $21 billion drug franchise without a revenue gap is a feat that Merck, Pfizer, and Eli Lilly have all struggled to match in their own patent cliff cycles. The commercial infrastructure score of 90 reflects the 30,000-person global sales force that can launch new products at marginal cost.
The global commercial network spans 175 countries with 25-plus commercial products and 50,000-plus patient access programs. For a pharmaceutical company, that breadth of commercial presence means every new pipeline asset has a global launch infrastructure on day one of approval.
The neuroscience pipeline is the next watch item. Emraclidine, a muscarinic M4 agonist for schizophrenia, advanced through Phase 3 in 2024. If approved, it could be the first novel schizophrenia mechanism in decades and represents a plus billion-dollar addressable market where AbbVie has commercial infrastructure already in place.
CEO Robert Michael came from inside the company. He spent a decade as CFO before becoming CEO in 2023. That background in financial architecture means the capital allocation decisions, the $63 billion Allergan bet, the buyback program, the dividend growth, reflect someone who deeply understands the economics of the drug lifecycle.
AbbVie executed the most successful patent cliff navigation in pharmaceutical history. Humira's $21 billion peak was supposed to crater the company when biosimilars entered in 2023, but Skyrizi and Rinvoq already generate more combined revenue than Humira at its peak, meaning AbbVie replaced its entire revenue base while growing it.
The thesis for AbbVie is about the next succession cycle. Skyrizi and Rinvoq patents extend into the 2030s, but the pipeline in neuroscience, schizophrenia, depression, oncology, and aesthetics represents the foundation of the decade after that, and a 4% dividend yield while the pipeline de-risks makes the weight paid. AbbVie reported Q1 2026 revenue of $13.3 billion, up 8.4% year-over-year, beating the $13.1 billion estimate. Adjusted EPS of $2.65 topped the $2.59 estimate by 2.3%. Skyrizi and Rinvoq combined for $5.6 billion in revenue, growing 53% year-over-year. Management raised full-year adjusted EPS guidance. The Humira transition is ahead of schedule.
AbbVie was spun off from Abbott Laboratories in 2013 and has grown into one of the world's largest pharmaceutical companies by market cap. The company became the dominant global seller of Humira, the world's best-selling drug for over a decade, before the loss of U.S. exclusivity to biosimilars in January 2023. AbbVie acquired Allergan in 2020 for $63 billion, adding Botox and the medical aesthetics franchise to its portfolio.
At $339 billion in market cap, AbbVie trades at 17.8 times forward earnings, a premium to pharmaceutical peers reflecting its growth trajectory in immunology. CEO Robert A. Michael became CEO in January 2023, inheriting the Humira cliff and the Skyrizi and Rinvoq ramp. AbbVie has increased its dividend for 12 consecutive years and currently yields 3.4%, a dividend aristocrat.
Q1 2026 revenue of $13.3 billion beat the $13.1 billion estimate, a 1.9% outperformance. Total revenue grew 8.4% year-over-year, accelerating from 4.2% in Q1 2025. Adjusted EPS of $2.65 beat the $2.59 estimate by 2.3%. Adjusted operating margin reached 35.1%.
Skyrizi and Rinvoq delivered $5.6 billion combined in Q1 2026, growing 53% year-over-year. Skyrizi reached $3.3 billion, driven by new approvals in Crohn's disease and ulcerative colitis beyond its original plaque psoriasis indication. Rinvoq delivered $2.3 billion, with atopic dermatitis and Crohn's disease driving the majority of growth above the original rheumatoid arthritis indication.
Humira revenue declined to $1.8 billion, a 37% year-over-year decline. This is a meaningful deceleration from the 50% plus decline seen in 2024 as the biosimilar market matures. Humira's remaining patient base, those not switched by payers to biosimilars, is becoming more stable. Management expects the annual Humira erosion rate to moderate to 20 to 25% going forward.
The Allergan aesthetics segment, Botox Cosmetic and Juvederm, generated $1.3 billion in Q1 2026, recovering from 2025 softness. The oncology and neuroscience segments combined for approximately $2.2 billion. Total pipeline revenue from Skyrizi and Rinvoq now exceeds Humira at its peak on a quarterly annualized basis.
Operating cash flow for Q1 was $5.8 billion. Free cash flow on a trailing 12-month basis was $21.5 billion, more than 2 times the annual dividend payout of approximately $10 billion. AbbVie returned $2.7 billion to shareholders in Q1, $2.3 billion in dividends, and $400 million in buybacks.
Management raised full-year 2026 adjusted EPS guidance to $12 to $12.32 from the prior $12 to $12.20, a 12-cent midpoint increase. Revenue guidance of $55 to $56 billion implies 7 to 9% year-over-year growth. The guidance raise is the third consecutive quarter where AbbVie has increased its full-year outlook.
Robert A. Michael became AbbVie's CEO in January 2023 after serving as Chief Commercial Officer overseeing the company's commercial operations. He previously spent over a decade in various leadership roles within the pharmaceutical industry. Michael inherited the Humira biosimilar challenge and has successfully orchestrated the commercial transition to Skyrizi and Rinvoq, managing one of the largest patent cliff navigations in pharmaceutical industry history.
Analyst consensus heading into Q1 2026 was approximately 16 buy ratings, 7 holds, and 0 sells. The average price target was $215, representing 12% upside from the pre-earnings price. The EPS beat and guidance raise were modest, but consistent with AbbVie's pattern of conservative guidance, followed by gradual outperformance.
The bull case centers on the Skyrizi and Rinvoq growth trajectory. Management's combined peak sales target of $24 billion is now supported by Q1 data. At $21 billion in annualized run rate, the drugs need to grow approximately 14% annually to reach peak. Analysts at Morgan Stanley argue the two drugs could exceed $24 billion if Rinvoq's atopic dermatitis indication continues to outperform.
JP Morgan maintained overweight with a $225 price target post-earnings, citing the Humira erosion deceleration as a positive inflection. The thesis: every quarter that Humira erosion rate moderates gives AbbVie's growth drugs more time to compound. At the current Skyrizi and Rinvoq growth rate, AbbVie's total immunology revenue will exceed Humira's 2022 peak by 2027.
More cautious analysts focus on the aesthetics segment uncertainty. Botox Cosmetic faces competition from Revance Therapeutics' Daxxify, a longer-duration neurotoxin that has gained market share in the medical spa channel. If Daxxify accelerates its penetration, the $5 billion Allergan aesthetics franchise faces structural headwinds not reflected in current consensus models.
The consensus takeaway: AbbVie is executing the Humira transition better than feared. At 17.8 times forward earnings with a 3.4% dividend yield, it offers the rarest combination in the S&P 500, growth plus income. Watch Skyrizi and Rinvoq quarterly run rates as the primary valuation driver through 2027.
The bull case is a compounding immunology franchise. Skyrizi and Rinvoq are not single-indication drugs. Each has multiple approved uses across autoimmune conditions, with ongoing Phase 3 trials in additional indications. As each new approval adds incremental patients, the combined franchise grows without requiring new drug launches. Management targets $24 billion in combined peak sales, above Humira's $21 billion peak.
The dividend compounding argument is underappreciated. At a 3.4% yield, growing approximately 5% annually, AbbVie's total return profile competes with growth stocks without requiring multiple expansion. Institutional investors running income mandates view AbbVie as a core pharmaceutical holding, creating structural buyer support that limits downside.
Pipeline optionality is not priced in. Navitoclax in myelofibrosis has Phase 3 data coming in H2 2026. Emraclidine in schizophrenia represents a billion-dollar-plus peak sales opportunity. If either drug achieves approval by 2028, AbbVie's revenue beyond the Skyrizi and Rinvoq cycle has a growth engine not reflected in current consensus.
The bear case starts with concentration. Skyrizi and Rinvoq are both JAK inhibitors or IL-23 antagonists competing in the same autoimmune market. If a competitor launches a superior mechanism, such as an oral IL-23 inhibitor or next-generation JAK selective, both drugs could face simultaneous share loss. AbbVie's entire growth narrative rests on two molecules.
Drug pricing risk is significant. The Inflation Reduction Act's Medicare price negotiation could reach Skyrizi and Rinvoq by 2028. A 25% negotiated price reduction on $13 billion in combined annualized revenue would reduce earnings by approximately $3 per share, eliminating the EPS growth embedded in the current multiple.
The leverage from the Allergan acquisition creates risk asymmetry. Net debt of $47 billion at current interest rates costs AbbVie approximately $2.4 billion annually in interest expense. If the aesthetics business underperforms and Skyrizi and Rinvoq growth decelerates toward 20%, free cash flow compresses while debt service costs remain fixed.
Aesthetics is a discretionary business. Botox, cosmetic, and Juvederm volumes are correlated with consumer confidence and the wealth effect. In a recession scenario, aesthetics revenue could decline 15%, erasing the recovery story and pressuring the company's ability to raise the dividend at historical rates.
The large-cap pharma peer comparison, AbbVie versus Johnson & Johnson and Merck. J&J trades at 14.5 times forward earnings despite a diversified business. Merck trades at 13.2 times despite Keytruda generating over $20 billion annually. AbbVie's premium reflects its growth rate, 8% revenue growth versus mid-single digits for both J&J and Merck.
Bristol-Myers Squibb is the patent cliff comparison. BMS navigated the Revlimid loss with Eliquis, Opdivo, and Zeposia, similar to AbbVie's Humira replacement with Skyrizi and Rinvoq. BMS trades at 10.8 times forward earnings because its post-patent cliff growth story is less clear than AbbVie's. Investors pay a premium when replacement drugs are already growing above 50%.
Amgen is the biologics peer. At 14.2 times forward earnings, Amgen trades at a discount to AbbVie despite a comparable dividend yield and biosimilar business. The difference, Amgen's growth profile is lower. Amgen's biosimilar portfolio is a defensive moat. AbbVie's Skyrizi and Rinvoq are an offensive growth engine.
Eli Lilly is the growth premium benchmark. Lilly trades at over 30 times forward earnings on GLP-1 drugs Mounjaro and Zepbound. AbbVie at 17.8 times is a discount to Lilly on a pure growth story basis, but AbbVie pays a 3.4% dividend and has already proven its pipeline transition, reducing execution risk.
Pre-earnings options positioning was bullish. The put-call ratio settled near 0.68, consistent with investor confidence in the Skyrizi and Rinvoq trajectory. The options market implied a 3 to 4% move around earnings. The 2.3% EPS beat and guidance raise drove a modest positive reaction, within the expected range and consistent with AbbVie's pattern of disciplined outperformance.
Post-earnings call activity was modest but constructive. Institutional buyers targeted the $202.10 strikes for June, reflecting confidence in continued Skyrizi and Rinvoq outperformance through Q2. The relatively narrow implied volatility at earnings reflects AbbVie's reputation for conservative guidance and consistent delivery.
Insider activity at AbbVie is stable. CEO Robert A. Michael and other executives have participated in standard equity compensation vesting programs without significant open market selling. The board maintained the dividend increase announced in October 2025, a 6-cent per share quarterly increase, signaling internal confidence in the cash flow trajectory.
AbbVie returned $2.7 billion in Q1, $2.3 billion in dividends, and $400 million in buybacks. The dividend has grown every year since the 2013 spin-off from Abbott Laboratories. Free cash flow of $21.5 billion on a trailing 12-month basis covers the annual dividend at a 2-to-1 ratio, providing significant cushion even if Humira erosion accelerates.
AbbVie delivered 8.4% revenue growth, $2.65 adjusted EPS above estimate, guidance raised for the third consecutive quarter. Skyrizi and Rinvoq at $5.6 billion quarterly, growing 53%, confirms the Humira transition is executing ahead of schedule.
Risks are real. IRA drug pricing, Allergan leverage, aesthetic cyclicality, and Skyrizi Rinvoq concentration. At 17.8 times with a 3.4% yield, AbbVie is value plus growth in pharmaceuticals. Watch the quarterly Skyrizi Rinvoq run rate and Humira erosion rate. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last.